When we are talking about entity planning, it is very, very important for you to understand what is something important to you. Because if you look at the social media, somebody's talking about, hey, you need to have S Corp strategies, and somebody talks about LLC, somebody mentions C Corp is a way to go, and somebody says C Corp is a horrible idea because you pay tax twice. You enjoying the social media, you're really confused that what is something good for you. So here I'm going to break it down, the entire entity planning. We call them entity planning. So what form of corporation, LLC, S Corp is right for you? Hi, my name is Neil Jasani, and I run Neil Jasani Tax Advisor as a CEO and president. We are a group of, actually in-house group of highly experienced CPAs and IRS enroll agent and, actually tax attorneys and other advanced tax planner. We also house some of the finest CFO and the controller level people on the staff. We work out from our, actually Miami office. We are somewhere around 25 plus, actually professional working out from our same 10,000 plus square feet office over here. And we have a client across the country. Our majority of clients are in California, New York, New Jersey, Illinois, so on and so forth. Obviously, we do have actually quite a bit client in Florida, Texas, and some other part of the country as well. Our clients are usually falls in two buckets. One is high W-2 earners, executives, engineers, actually very, very successful professional making at least $2 million or so. And other bucket is very successful small business owners. So it could be dental, medical, law practice, software, IT, any other professional business where owner is, actually netting at least $2 million or so. That's where we really shine. That's where we create lots of value. And that other, once you reach at that level, it's not only income tax is your problem, but then it is the asset protection, it's the estate tax, it's the wealth preservation, it's the actual generational wealth, it is the estate planning. So many things comes into play, and that's where we really shine, because you have every kind of professionals that are actually working from the same office, and there's only one pocketbook, so there's no conflicting interest. Not everybody needs to get paid, right? It is one company, and it is that other, everybody works for that one as the W-2 employees. So all of our people work as the W-2 employees. Those are not contractor working from somewhere else, and that other we do work all from our office. So it is all made in America rather than outsourced to some other companies. Let's talk about the S Corporation. You will hear so many people talked about S Corp. S Corp is the strategy. You need to have S Corp. So why they are talking about and what exactly the S Corporation. So what happens is essentially, let's say your gross revenue is the $100,000. So it is very small. The second example is, let's say your gross revenue is $1 million. And the third example is your gross revenue is $10 million. By the way, this video is more geared toward to the people who makes more money, because normally we deal with a client who makes more than $2 million net from any kind of the business. So ideally their gross revenue would be $5 million to anywhere $500 million or so, basically. So let's say you have the $100,000 gross revenue, and if you're LLC and let's say your expenses is only $20,000, then on the $80,000 you are paying something called FICA tax, which is a self-employment tax, Social Security, and the Medicare tax, which is somewhere around 15% plus, basically employer and employee side. Now, if you keep that one as the LLC, then you are paying on the $80,000 the self-employment taxes. But if you make the S Corp election, then you can take something called reasonable salary. And most of the time on the internet, I have seen people miss that part. Basically, they said, hey, you take the small salary and actually remaining comes out as a K1, so you don't pay taxes. When they are talking about taxes, you still have to pay the state income tax. You still have to pay the federal income tax. What we are talking is one more tax on top of that one. Those are called the FICA or the self-employment taxes, which is around 15%. So meaning when you're taking as the, say, K1, then you don't need to pay that 15% taxes on that one. So let's say the $80,000 left, and you say, hey, I'm going to take the $30,000 as the salary, salary, and the 50,000 comes as the K1. So now you're saving the 15% on that $50,000. So that is the example for, say, somebody's making a total $100,000 in the gross revenue. Now, the second example, let's say you run a reasonably successful business and your gross revenue is $1 million, right? So now you will see the impact. So let's say on the $1 million, your total gross revenue, and let's say your expenses is, say, for example, 20%, which is actually 200,000. So now you're left with $800,000. So if you have as an LLC, then you are going to pay the Social Security tax up to $160,000 first, which is at the, say, 12% rate, and then remaining entire money, you're going to pay 3% Medicare tax. So let's say that are 800,000. So on the entire 800,000, you are paying the 3% Medicare taxes. So it is, somewhere around, actually $24,000-$25,000 you're paying as the Medicare tax. But if you were to make election of S corporation, right? So that you can have your LLC tax as the C Corp, as a self-employment, or as the partnership, or as a C Corp, basically. So that if you were to elect as the S Corp, now guess what? You don't need to pay that 3% Medicare tax on entire 800,000. What you can do from the 800,000, you can take some reasonable compensation, and the IRS has a guideline. We call them RC report. It's called the reasonable compensation report. So you take that reasonable compensation. So let's say you take, say, for example, $200,000 as the reasonable compensation. Then $600,000 will come as a K1. And guess what? You don't pay that Medicare, the 3% tax on the K1. So on the $600,000, you're saving the 3%, which is somewhere around $18,000 or so you're saving. So that's the idea of the S Corp. Now that let's go to the $10 million revenue. It is the same logic. If it is LLC and you continue to take money out, then you're paying the 3% even on the $8 million net you are going to have it. So that's where the S corporation comes into play. Now let's talk about C corporation. When C corporation makes sense. So that actually you will hear the two sides of the story on the internet. Some people say the C corporation is a way to go, and some people say, oh my God, you shouldn't be doing the C Corp, or you're paying, actually double taxation. So that the C Corp, you pay the taxes at the corporate level, and then it adds on your personal income tax. So that actually you're going to pay taxes again at your personal individual tax return. So people that you will hear, that's what it means, the double taxation. So why one should do the C corporation, or why should not be doing it? So it is very easy to understand. Once you understand what is your goal of business, who you are, where you want to go, then it's very easy to make a decision. So let's say if you're planning to be a small business owner, if you are going to be, say, in the range of anywhere from 100,000 gross revenue to $10 million, then the S corporation is a way to go. And there's a better way to do that. You can create the LLC, select the tax as the S corporation, basically. And that I'll tell you why it is important, because that you will also hear online that people say, hey, you want to have your business owned by your trust. Guess what? If you have the S corporation, trust cannot own the shares of the S corporation. So if you select the LLC and tax as a S corporation, so you're essentially getting the benefit of the S corp, but now your trust can own the shares of your LLC, basically. So that the idea is, if you're going to be small and that you don't have a lot more ambition, primarily you are the main guy who's making lots of money and you have other employees, then the S corporation is a way to go. Basically, it would be much better idea. But let's say you're planning to build something really big, right? So if you are starting some tech startup or some other sort of startup, that's where you're planning to take the, say, outsider money. You are going to hire the high profile employees. You are going to give them the stock options. You're going to give them the incentives. You want to attract that the very, very powerful talent. Then the C corporation is a way to go, because it will make a lot more sense, not only from all other perspective, but it will also make sense from a tax perspective as well. Because when you are running the high growth company or you're planning to build the high growth company, then essentially you will end up spending quite a bit money on the expenses. It could be the salary and wages, or R&D, or actual marketing, so on and so forth. So you are not going to have a lot more money in terms of profit. And that, let's say, even though you're running very, very profitable, high EBITDA company, still that money can stay in the corporation basically, and that you don't need to take a distribution. So that's the advantage of the C corporation. Also, you can do really neat strategy with the C corporation at the time of exit. So when you are selling it, you are going to public, whatever you want to do, there's quite a bit tax strategies, and that obviously those are the areas that we make lots of impact. I mean, when I say lots of impact, we can make impact in your taxes from anywhere from 5 million to $500 million or so, basically. But that's where the role of C corporation comes into play. So let's say if you're planning to be a small guy, absolutely C corporation does not make sense for you. But if you're planning to become big, or let's say you was not planning to become big, you start as a small, and then you realize that I have that actually found something that can go really big, then probably it is a great idea to convert or do the right kind of entity planning, and that use the C corporation at your advantage. Let's talk about the trust. Actually, you would have heard some person talking on the internet or on the social media that you want your business to own by the trust, which is that actually a great idea, but you need to understand what is a trust and what kind of tax implication of the trust is. So trust can be two types: irrevocable and revocable. Here, the most people are so confused. They will talk about trust, but when they are not talking about it is either revocable or irrevocable, then you are entirely missing the point, because there is a totally different tax treatment. And when we are talking about the trust, you need to talk about two other kind of taxes as well. So primarily we talk about income tax, but you need to talk about gift tax, and you need to talk about estate tax. So it is very, very important you understand holistically. Otherwise, you ended up creating something and hurting yourself on the other side. So that actually what happens is a revocable trust. You would have heard about family revocable trust. So when any business owned by the family revocable trust, it does not make any difference in your income tax, gift tax, or state tax, because it is a revocable trust, meaning you are the creator or the grantor of a trust, and you have a right or the authority to revoke. So you do not get any asset protection, you do not get any tax advantages, you don't need to worry about your actual gift tax exemption limit, your state tax exemption limit, because you're not making any gift. So why do you think people create the family revocable trust? So primarily reason people create the revocable trust is to avoid the probate, basically, right? So that's the primary logic. It creates the convenience. You and your spouse can, own the asset separately and still control and still feel that it is a joint asset. So that's the primary reason you do the family revocable trust, but it does not give you the asset protection. It does not change any your tax, that other income tax environment, and it does not impact to your the gift and estate tax. Whenever you create the irrevocable trust, now that all of these things are changing, basically, so that let's say that if your business is owned by irrevocable trust, or you're planning to own by the irrevocable trust, then first you need to transfer from your name to irrevocable trust. So whenever you are transferring, at the time you are technically making a gift, basically. So that's where the gift tax will come into play. That's where the state tax will come into play. So that at the moment, currently, currently that, that the state tax exemption is, somewhere around 13 million per spouse. If you're married, it is somewhere around 26, $27 million. That's what you are looking for. So that actually, whenever you transfer the business to the irrevocable trust, basically you will remove from your state, meaning you used up that actually $27 million worth of the gift tax or the state tax exemption. And that other, by the way, the gift and state tax goes hand in glove. So easier way to understand both of them is while you're alive, it's a gift tax. When you are dead, then it is estate tax, basically. So it is the same thing, right? If you want to use that exemption right now, so it would be considered a gift tax. And once you are gone, then it would be considered as a estate tax, basically. So that is what the difference, right? So that actually what happens is when it is your business is owned by the irrevocable trust, then it is out of your state. Then you are getting the asset protection because you does not own the business by yourself. But so many times you will hear, hey, if I transfer to the trust, I don't need to pay taxes. No, wrong. You still need to pay tax, that you will be taxed at the trust, that are actually income tax. And by the way, that actually many a time it is expensive than the other way around. Also, when you create the irrevocable trust, yes, it is going to be out of your state. It is going to give you asset protection, but guess what? Now you lose the control over that one. So that actually technically only reason it is out of your state because you gifted it, you gave it away. So meaning once you gifted somebody or when you gave it away, then obviously you can't really control, at least directly, right? That's where that actually our attorney, our actually in-house attorneys, they do create a very, very powerful form of trust that you can still indirectly control them. Obviously, you can't really control them directly, but you can still have some say. But that is what you need to be very careful is that actually whenever you're transferring your business to the trust, and especially irrevocable trust, that's where you're making some impact in terms of the actual state tax and the gift tax and overall the asset protection, but then you are giving up lots of control as well. So finally, to summarize, what type of entity is right for me? It is LLC, it is S Corp, it is C Corp, trust, should my trust own it, and so on and so forth. So that actually simple way to look at is, let's say you are starting out something, you don't know, you are planning to buy the real estate and rent it and so on and so forth. Then LLC is a way to go, simple and easy way to do that one. Let's say that you have some ambition to really build the business, right? So at the time, I would probably do, instead of that other, S corporation, I would do the LLC and, select the tax as S corporation. So you're getting the same tax benefit, but if you happen to grow that other, really to good size and so on and so forth, then you can transfer the shares of your LLC to your trust. It could be revocable trust or irrevocable trust. And let's say you are starting some, that actual business, which you have a high hope. You are planning to, hire very, very talented people. You're planning to take some outside money. So either in a form of angel investment or, venture funding or so on and so forth, then that other C corporation is a way to go. So these are the actually very, very easier way to figure out that actually what kind of entity is actually right for you. And that actually, by the way, that's where we go quite a bit in detail, and that actually we will help you form the right kind of entity also in a right state. Also, you need to make sure that actually when you do the C corporation, you want to authorize the right kind of shares, that you want to put someone in options pool and so on and so forth. So there's quite a bit things goes into that one.